Welcome to this explainer. Today we're unpacking the quiet, slow-motion unraveling of the global financial order and exactly what that means for your wallet. You know, it's so easy to get distracted by the daily headlines, but right beneath the surface, there's this massive structural shift taking place. We're literally watching the gradual transformation of the financial system that has powered the whole global economy for half a century. So today, we're going to use the data and the historical record to see exactly what's happening, why it's happening, and how these distant geopolitical shifts are absolutely going to land right on your kitchen table. So let's just dive right in. 95%. That staggering number represents a very real crisis. See, recently, vessel traffic through the critical Strait of Hormuz plummeted by up to 95% amidst all this heightened Middle East tension. Basically, that removes millions of barrels of oil per day from the global market. Now, to most people, this just looks like a purely physical supply shock, something that'll eventually get resolved, right? But this disruption is actually masking a much bigger story. It isn't just about the price of crude oil, it's about the specific currency being mandated to buy it. And hanging in the balance is a staggering $2 trillion. That is the collective value of Gulf state assets. We're talking everything from U.S. Treasury bonds to real estate and tech investments that are currently held right here in the United States. If these nations decide to pull back even just a fraction of those assets, it could create an enormous liquidity vacuum in the global market. The U.S. Treasury is keenly aware of this, which is exactly why we're seeing some unprecedented efforts to make sure these assets aren't sold off in a chaotic way.
Section 1. The geopolitical tremors.
To understand why those numbers are so alarming, we really need to look at the immediate crises shaking the foundation of global trade. I mean, we're witnessing unprecedented events right now. Major oil choke points are severely disrupted. You've got the UAE breaking away from OPEC to operate on its own terms starting in 2026. And there's this visible, undeniable diplomatic friction flaring up between the US and Saudi Arabia, which was definitely highlighted during a recent Miami Investment Summit. All of this creates a super tense environment where the threat of foreign powers selling off their U.S. asset holdings becomes a very real leverage point.
Section 2. The 1974 masterpiece. To fully grasp why these modern fractures matter so much, we kind of have to travel back half a century to a brilliantly simple arrangement that, quite literally, rebuilt the modern global economy. Think back to 1971. President Nixon ends the gold standard, meaning the U.S. dollar desperately needed a new anchor. Enter a largely secret 1974 deal orchestrated by the U.S. and Saudi Arabia, the birth of the petrodollar. Saudi Arabia agreed to price its oil exclusively in U.S. dollars. Fast forward 50 years to 2024, and that original security for oil agreement officially expired. And that expiration leads right into the fractures we see today, like the UAE planning to leave OPEC in 2026. Now, the absolute core concept of that 1974 agreement is what we call petrodollar recycling. This is the hidden engine, the secret sauce that has powered American financial dominance for 50 straight years. By ensuring every nation on Earth needed dollars to buy energy, the U.S. basically created a permanent structural global demand for its own currency. Here's the exact plumbing of how this system works. Step 1, Saudi Arabia, and subsequently the rest of OPEC, prices its oil exclusively in U.S. dollars. Step 2, they take their massive surplus profits and invest them right back into U.S. Treasury bonds. And step 3, this is the kicker, the United States government uses that constant flow of foreign cash to fund its national deficits. This gave America the exorbitant privilege of cheap borrowing. It allowed the country to run persistent deficits for decades without ever facing a currency collapse. Section 3. The silent financial pivot. But under the surface, a silent and profound pivot is slowly rewriting the rules of this entire system. Because you see, the strategic logic has completely flipped. Back in the 1970s, the U.S. desperately needed Gulf oil and in return provided a massive military security umbrella. Today, well, thanks to the shale revolution, the U.S. is a net energy exporter. It just doesn't need Middle Eastern oil like it used to. Meanwhile, China has emerged as the Gulf's absolute top energy customer, taking in over 20% of all Saudi oil exports. The incentives have totally changed. Enter Project Enbridge. Now this is fascinating. Enbridge is a parallel financial pipeline, a cross-border digital currency platform that lets nations settle trade bypassing the US dollar and the SWIFT network entirely. And this isn't just some experiment anymore. It hit $554 billion in cumulative transaction volume by late 2025. With the UAE and Saudi Arabia joining as full members, it's a functioning rail that is totally immune to U.S. Treasury sanctions or asset freezing. Washington literally has zero jurisdiction over these trades. Because these alternative systems are growing, global central banks are quietly diversifying. Back in 2001, the US dollar made up 72% of global foreign exchange reserves. Today, that has dropped to 56%, which is a 31-year low. Central banks are increasingly voting with their balance sheets, actively reducing their exposure to the dollar. Which brings us to Section 4, the new resource chessboard. As the dollar slowly loses its monopoly, the geopolitical focus is shifting. But first, get this. Look at the massive irony of our current oil geography. The U.S. Navy spends billions patrolling the Strait of Hormuz to keep it safe, yet only 2.5% of the oil flowing through that strait actually goes to the U.S. A massive 37% of it goes straight to China. The U.S. is basically bearing the heavy cost of a security guarantee for a resource it doesn't even really need for a geopolitical competitor who is actively building alternatives to the U.S. dollar. Wild, right? Furthermore, we have to remember the future of the global economy runs on electrification and critical minerals. When a solar panel generates power, it does so locally, entirely bypassing those global dollar-denominated oil markets. Because of this, the U.S. is having to shift its strategic focus back to the Western Hemisphere. They're eyeing vast, underdeveloped resources right in their own backyard, spotlighting places like Cuba for cobalt and Venezuela for heavy crude, all to build a more secure, localized supply chain. Finally, Section 5. Impact on your wallet. Because what happens on this global chessboard? It definitely does not stay there. So you might be sitting there wondering, okay, but what does this mean for my money? Why should an everyday consumer care about what currency oil is traded in halfway across the world? Well, here is the brutal arithmetic. If foreign states, like those massive Gulf sovereign wealth funds, decide to modestly sell off or even just stop buying U.S. treasuries, it has an immediate impact. Studies show that a $100 billion sell-off of U.S. treasuries by foreign officials can spike the 10-year yield by a full 100 basis points. That's a full 1% increase in interest rates, just like that. And that spike, it triggers a mathematical domino effect. Step 1, foreign demand for U.S. debt shrinks. Step 2, to attract any remaining buyers, the U.S. government has to offer higher yields, meaning borrowing costs absolutely surge. And step 3, those higher yields ripple through the entire domestic economy. It directly drives up your mortgage rates, your car loans, and inflates everyday costs. That hidden subsidy that allowed the U.S. to consume more than it produced for 50 years, it's slowly evaporating and passing the bill straight to the consumer. But, it's absolutely crucial to remember this quote right here. Empires and financial systems don't die overnight. They slowly deflate. These massive structural shifts happen gradually over a long sunset rather than in sudden overnight crashes. Capital slowly moves to the edges, alternative rails get a little more traffic each day, and the old system just loses its monopoly. So this leaves us with one giant lingering question. Can the U.S. navigate this fragmented reality, fix its reliance on cheap foreign debt, and adapt its economy to a multipolar financial world before the rest of the world forces that adaptation upon it? It's a pressing puzzle that's going to reshape all of our wallets. Thanks so much for joining me for this explainer, and remember, keep your eyes on the data.